So today we once again we have help from behind the great big blue curtain from Mallory Vaughn. So Mallory, we're going to get started with the DGI COVID chart, which is where we start every Friday. There we go. Okay, so this is the more long term. You see our deep dip down here, which is March 24th. Now, what's been interesting is, as I've explained before, the gold line here is the 7-day moving average. The silver line is the 14-day moving average. And you can see, obviously, this is very volatile through here. And then you can see back here, it started, that was about 10 days ago. Things have started to flatten out. So the lines are starting to merge. You've got the daily average, the daily price, the 7-day moving average, the 14-day moving average. Those are all kind of coming into line. That's not a bad thing to see, but it also tells me that we're kind of positioning ourselves or positing ourselves to some kind of movement coming up. And a lot of folks are saying there's going to be a big movement this month, sometime in July. I'm not quite yet confident that's going to happen. We're seeing some of the earnings come in from the quarter, and we're seeing some surprises, not as many as I thought we would see. We're seeing Delta Airlines post was huge loss, but that was not a big surprise. So we're moving along, and these lines are flattening out. And I think that what this tells us is it's not time to get too excited yet, but it's still time to be cautious and see where we go in the next couple of days. I think last Friday we were looking at not a very good day. We ended up being up, and we've had a couple of days like that where the futures were either down a lot or up a lot at 5 o'clock in the morning, which is usually about the time I look at the first one. And then by 10 o'clock, they completely reverse themselves. So the market is a little bit volatile, but when you see these lines starting to merge, a little less reason for concern. So Mallory, if we could go back to that first chart, and this is more of a focused look on the recent couple of days. You can see this goes back to the 1st of June. And once again, the blue is the daily movement. And then you've got the 14-day and the 7-day average. And you can see there, even when I'm looking in and coming in closer to the forest and looking more at the trees on this case, you can see how these lines down here are kind of merging. And that's not a bad thing at all. It just means that some of the volatility is going away. We're not seeing some of those huge swings every day. We're not seeing great big news reports affecting the market too much. So what we're seeing is a little bit of stability in the market, and that's kind of nice. The next thing to see is where it goes from here. Does it break out up or does it break out down? And if anybody tells you they know which way it's going to go, they're probably guessing. And I'm going to tell you, we don't really know right now. Earnings season, there's surprises all over the place, up and down. So we'll just have to wait to see what happens. But my point here this week is that this is kind of good news. You're seeing some moving averages merge, and you're seeing the daily price here is kicking up a little bit. You got a bit of a down day. So some volatility is kind of flattening out. So we're going to go to world markets now, and we try and look at this. And again, over here on the right-hand side, you're going to see the red indicating that they were down from last week, the green they're up from last week. And then here, this is the performance since the deep part of the COVID on where they are. And the interesting part is, as we've seen before, the NASDAQ, which is basically the technology index in the United States, is clearly defeating everybody. It's up 16.7% for the year. Not a big surprise. I'm going to show you the big surprise on the next page. And so you can see that the Dow is down about 6.3%. The S&P 500 is down 0.5%. The S&P 500 actually is a very good indicator of the broad market because there's 500 companies involved, whereas the Dow Jones is only 30 great big companies that you've all heard of. But the S&P 500 is a much broader index for us to watch, and it's a fair benchmark, a more fair way to rate how we're doing. So the S&P 500 being basically flat, that's pretty good news. But then you see the rest of the world in here, and how they're being affected, and they're still getting hit pretty hard. And these are not undeveloped countries. These are not emerging markets. These are all developed, high industrialized countries, and they're still kind of struggling with their numbers. So Mallory, go to the next page, the US recovery specifically. So here we have the Dow Jones Industrial Average and how we're doing after the bottom. And this again is just a summary of where we've been, how we ended the year, where we were in the deep part, where we are as of the close last night. And so, this is just us focused and what we tend to look at. We update these, obviously are constant. This chart, when it's live on my desk, is updating by the moment, so I can see how things are going. And we started to see this flattening out about 5 days ago. Yeah, we've talked about. Let's move on from there. Oh, I'm sorry, Mallory. Yeah, go back to that, please. So this is this week. This is the Dow Jones Industrial Average this week. The DJI is up 2.4%. NASDAQ is down 1.4%. That was my surprise I referred to a second ago. And the S&P 500 is up 1%. So NASDAQ is the high tech. And I showed you where that's up 16% for the year, beating all the world markets that I'm looking at and beating the 3 US indices. But this year, the NASDAQ's got beaten up. Tech is in there, and it hasn't done as well. However, still over the long haul, even though the tech has had a tough week, they're still outproducing all the other indices. But this is how we've looked since the opening on Monday. Today, we'll see how it goes today. We'll see some recovery, it looks like, and we'll have to keep an eye on that. Volatility is going down. So we'll have to keep an eye on how it goes. But right now, this is how the week is going. The interesting to look at here is if you multiply this times, let's say 50 just around it, are these good numbers? Well, if I do 2% every week for the year, I'm pretty happy with that. If I do 1% every week for the year, I'm really happy with that as well. And if I do negative 1% for the year every week, then I'm not very happy with that. So you never want to look at just how we're doing this week. You always want to step back. How are we doing for the long term? But for the week, that's how we did. So this is treasuries. Back here, you saw an inverted curve. This was extremely brief. It didn't take very long, but this is the 10-year treasury, the gold or red line. The blue line is the 2-year treasury. And what should happen is investors should be rewarded for going longer term. They should be able to see that spread. And as those merge, and that's what happened here, where the 10-year reward was equal to or less than the 2-year reward, that's never a good thing. And 22 times out of 23, that converted yield curve was followed by a recession. And sure enough, here we have it. People said it was short, so it probably won't happen. However, we've been saying since October of 2000, I guess it's 2017, 2018, we've been saying that we're looking at a recession in the next 24 months. So here where we officially entered a recession back here. So now the treasuries have this great big spread, which is comfortable, but it's still not good news when you're looking at fractions of a percent yield on US treasuries. The key there is that when we're doing investing, the one things that we can count on, and the one place where we can say we guarantee a return, is if we're putting US treasuries into a portfolio. It's not very exciting when our guarantee is less than 2% for the next 10 years. Still, this spread is good. And what we're hoping for at this point is as we come out of this COVID, we come out of this recession, that these numbers start climbing back up and we end up back over here where we still have a nice solid spread and we have rates that are going up higher to where we can get some solid fixed income return for 2 and 10 years. That would be a good thing. The goal for the Fed is to get this number. They need about a 3% in there somewhere so that long-term investors can get a 3% return guaranteed on their treasuries. That's the long-term goal of the treasury. That's the long-term goal of any solid economic platform, is you need to have those numbers a little bit high. So while we've forced that rate at 0, Japan tried this in 1990. They kept it at 0 for 10 years. It did not accomplish what they hoped it was accomplish. We apparently are trying it, and it probably won't accomplish anything more than what Japan was able to accomplish. And those rates will eventually have to come up. And somebody's going to say, well, they can't go down. You're right, they can't. They can stay down here for a while. And right now we're thinking they're going to stay down here through 2021. That's not great news, but we're looking for stability. We're looking for the spread, and we'll have to see what happens from here. So I've got another minute or so, and I thought I'd touch on something fun, and that's bulls and bears. And so how do we come up with bulls and bears? There's a lot of stories out there. One of them is, it's a little bit obscure, but there were these guys that used to basically would sell hides from bears, and they would sell the hides before they owned them. So their price was they'd go out, they'd sell the hide, then they'd have to go get the bear, find it, kill it, strip it. And their hope was that their cost to do that would go down before they delivered it. So that's where that came from. They were called bear jobbers. and that was shortened eventually to bears. That's one theory for the bear side. And the other theory, which is probably more likely, is why I've used this photo, is a bear attacks by standing up and coming down. A bull attacks by lowering his head and coming up. So a bear market is going down, a bull market's going up, and that's probably the most reasonable theory of what's going on. It's just a way to indicate what kind of market are we in. We're in a bear market, we're in a bull market, and where do we find ourselves. But the one thing to remember is we entered a bull market in March of 2009. And I've said before, we would like to double money in every 10 years, which means about a 7.5% return year over year. That would be great. But from 2009 to 2019, we went from 6,900 on the Dow to 28,000. That's 4 times. So we've had a really good 10-year run. What we're seeing right now is a little bit of a blip, but we also had a couple of blips during that 10-year run, and we were able to recover from them. So how long will this take? That's a really good question. How long will the recovery take? We don't know. We know that we still expect to see another decline in the market. We still expect to see another drop. It may be this month, it may be in the next 10 days. I think it'll happen before October, but I am just putting stuff together and based on what I see, we're prognosticators, we're economists, we can guess. We can tell you later why it did it. But right now we're still on the side of caution until some things happen. There is rumor, you heard the company thinks that they have a vaccine. My concern is they've only got 45 people in their first study. And while the results are positive, I'd like to see them go to the second phase and use more than 45 people. So appreciate your time. My time is up. If you have any questions, please email them into mmccauley at firstoptionfinancial or Mallory Vaughn, MVAUGHN at First Option Financial, and we'll get them on next week and try and address any questions. Or give me a call, 913-259-2110. And I'm here all the time. I will be in my office. And thanks for joining us. Have a great week. Stay cool. Thanks for coming.